Beginners get killed by false breakouts, but professionals know how to benefit from them and make money. So in this video, I'm going to teach you the difference between fakeouts and breakouts and show you how you can take advantage of false breaks to make profit even when the market reverses on you. So let's get to the learning. A breakout is the name that we give to the formation of a new high or new low in the market. So when we are trading within a range, whether that is just beneath a swing high like this one, or whether it is a completely sideways range like this, a breakout happens when we either break above or below a range. So in an uptrending market, just like this one we've got here, the breakouts are taking place at these points when the market is pushing through previous highs and forming new highs. Just like this example here. So this would be situated in an uptrend. What we're seeing here is the market pushing above and breaking out. Now the concept with a breakout is, and the way that you would trade a breakout, is once the market retraces, you would then look for buying opportunities to take this market higher, okay? So if the market was to close up here, that would confirm the breakout. And it's very simple to trade breakouts because once this is confirmed, we now know the market is continuing to move upwards. So we can just look for areas to buy from. For me, that's generally going to be supply and demand. So I'd be looking at this region here for my buys. And when the market pulls back into that region, I would buy because we'd have confirmed continuation of upside. But what happens then when the market doesn't close above these levels? What happens when the market approaches and attempts to push past one of these levels, but then is pushed all the way back down? Well, this that we're looking at now is what we call a fake out or a false break. And what this is showing us is a significant amount of selling pressure coming in at this high. The reason we are seeing selling pressure and the way that we can actually visualize this selling pressure is by the wicks or rejections or large bearish candles that the market forms after sweeping above a high. Now, when we see a wick like this is showing us a phase where buyers have attempted to go higher, but then have been pushed all the way back down by an influx of sellers. And if we see this taking place at this high, that tells us that there are lots of sellers waiting above the high. More sellers than buyers, in fact. And now, from this, we could potentially see the market reverse and go the other way. So this right here is what we call a fake out or a false break. It's the failure to close above or below a high or a low, then opening doors to a reversal. So in this instance, further downside instead of the upside, which seemed so obvious until the candles closed. Both of these formats, the fakeouts and the breakouts, can be great for trading opportunities. Now that we've covered the differences between fakeouts and breakouts, let's go to the charts and I'll explain why they happen and how we can start to trade them to make profit. I'm going to quickly show you a setup that I took very recently on EURUSD to explain to you how breakouts are traded. This is only going to be fast because it's very simple to trade breakouts. Now, when we are looking at a trending market, in this instance, a downtrend, the opportunities will arise when, first of all, we break into a new low. So the breaks into new lows can then be followed by pullback sell opportunities from supply zones, which would be, in this instance, where we are seeing this continued bearish trending price action after each breakout. And the other way we can trade it, and the way that I like to trade things, is reversals. So breakouts against the trend. Now, in an instance like this, where we're seeing the market printing lower lows and lower highs consistently, a breakout trade here would be, once we break above this structure, that's going to open doors to then looking for pullback buy opportunities. So it's at this level here, if the market is able to push above this level, that the breakout takes place. And from there, we can look for pullback opportunities to buy from. Now, skipping this market to the next candle, we see we did indeed get a breakout. So what I do from this point is use demand. Demand zone is just going to be last candle before an impulsive candle up or down. This demand zone is basically an area where buyers are accumulating orders, stop losses beneath the lows, and then targets up to wherever you're going to target. In this instance, we're looking to take out this previous high. So that would be a breakout trade. We have a breakout of this trading range, the range being pretty much this area of price action here. And then when we break out, we use a demand zone to actually buy from. And once that demand is retested, we get a push all the way through towards our targets, okay? So that's breakout trading. It's very simple. We are just looking for a continuation or reversal in the trend and then looking for an opportunity to buy into that new break. So that's how you trade a breakout. Nice and simple. But now, how do you trade fakeouts and how do you make money from them? Let's go to the chart and find out. So in this example here, we have got a downtrending market at this moment, but we are in a larger range. This is the high of the larger range, and that sits above what we call an imbalance, which is basically an open price range. We would anticipate generally, if the market is able to push and break below this level, that it will likely continue trading all the way through the imbalance down towards the next demand zone, which would be this level here. So for the majority of traders who focus on price action systems the same way as I do, we will be looking to generally trade through these imbalances once breakouts occur. But here's the thing. They don't always take place. Sometimes we are going to get those false breaks that we've been discussing. Sometimes the market's going to go the other way. So how do we take advantage of these then? Well, the first thing that we want to do when we are looking to work out whether a market is a fake out or a breakout is wait for a closure. So as we mentioned earlier in the video, here you can now see that we did not close below this level. So we're on the hourly time frame. We pushed beneath this hourly swing low here. But instead of actually closing, instead of getting a candle body closing beneath this level, there has once again been a wick pushing the market back above that point. Now, this wick that we see shows what? It shows rejections. So we see buying pressure commencing at this level and driving the market from this downward phase into this upward phase, which tells us that this could potentially be a fake out or a false break, a reversal that could take us into considerably higher prices. Now, to quickly explain why these false breaks take place, it's generally due to liquidity, okay? So with this swing low that we've been focused on being an interesting level to see the market break below, there will be people anyone who's bought above this level will have stop losses under here. And anyone who's looking for that break and retest trade, so the break, the pullback, and the sell trade, will have sell stop orders situated under this level, okay? Which basically means if the market trades into this, they will be automatically triggered in on a sell. And all in all, it just means there's a whole lot of orders underneath this level that can be activated once the market trades below. So with people anticipating the market going lower, buyers will get out of their positions to limit the risk and the loss. Sellers will get into positions to profit from this new downward movement. But what happens with this liquidity or this big number of orders, which is what liquidity is we now open up possibility for markets to reverse. Now, markets react to orders specifically. Buying and selling is what drives the market. So when we see the market come into an area where there's lots of orders or lots of liquidity, it's really where the market gets to make its decisions as to whether the buyers or the sellers are going to take control. So although these areas where we get breakouts can be some of the best places to take trades from, they can also be one of the most obvious places or most consistent places for markets to reverse. And when you understand this theory, you will be able to take brilliant trades. So how exactly do we take advantage of this then? We've discussed that the first step in seeing a false break and seeing a fake out occur is with wicks. But that is not going to be enough because, of course, we could wick and then go and break out later, right? So maybe we have a wick, we have another wicky candle, we have a small push up, but then we have a breakout. That could still take place. So realistically, what we need to see to truly confirm this and turn this initial idea into a larger trading setup is see a significant shift in structure. So if we consider the trending fashion of this market, then we have this high, then we have this lower low, we have a lower high, we have a lower low, we have a lower high, and then we have pretty much this lower low. Now we can also classify lower low, lower high, and lower low. So basically we've got some bearish trending structure with a significant high at this point and a significant high at this point. What we would want to see then to confirm that this is indeed a false breakout and a fake out instead of a breakout would be to see the market pushing above these levels, where we can then look for pullback opportunities to buy the market from. So if we let the market run forward a little bit, you see that we get a push away now, which breaks structure. And as you can see, we didn't wick this time. So the break of structure in question is this one up here. We've seen solid closures above the high, okay? Now, of course, if we'd have closed beneath this level again, that could have opened doors to potentially going lower because wick rejections failing to close over this high would tell us that sellers are taking control once again. But obviously in this instance, we didn't get that. We did get closures. You can see the candle bodies are higher than the previous high, which gives us indication that buyers are in control here. Now, if we consider how that weighs up to this level, well, what did we see? Sellers are obviously not in control because the wick has reversed the market and pushed us up higher. So here we have loss of control from sellers, and here we have confirmed control from buyers. So what we can now do is use different entry method techniques to get ourselves into positions. Now, a simple one is to incorporate Fibonacci retracements. You could use the area around the 71 to 78% Fibonacci levels. And when the market retraces to that level, that would become your optimal entry area for buys to commence. The other way you can do it is through refining the time frames. So you can go down to a lower time frame. This is what I like to do. And then what I'm going to do is identify the right demand zone to buy from. So from an internal structure perspective, we can see that we've got lower low, lower high, lower low, lower high, lower low. And then from this demand zone just here, this indecision candle, we had a push up, which has actually broken us above significant structure. So here we can see the demand zone in question is this one. And because this was the zone that broke some of the internal structure, this becomes a very interesting level to buy from. Now, I don't want this to confuse you. There is a card in the top of the corner of this video, which takes you to a class on inducement and zone selection. So if that confused you a little bit, just click that video after this one and check that out. So now that we have our refined area that we want to buy from, which is going to be this level just here, we would place our orders on this point, stop losses below the low, and then we can move our targets up pretty considerably higher. Because what we're really seeing here now is a rejection of lower prices and therefore an opportunity to trade into considerably higher prices. So just to break it down here in trading this fake out, we have sweep of low, rejection, and reversal to the upside. Closure confirming the control from the buyers, and then a refined demand zone, or you can use those Fibonacci techniques we just discussed to find your optimal entry for a position. And once you have that, you will just target wherever you want to head into next. For me, I always love to use areas of liquidity for positions because obviously we will be looking for a similar thing to take place potentially again when we get up there. For me, that's going to be the trade target here. You can use whatever methods you usually use. And then if we just allow the market to play out, you will see that we get a tap in and then we get a run through to our trade targets. So that is how you trade a fake out or a false breakout. Okay, you can just see there we just ran into the target, took a little bit longer, a couple of days in this position, but that would be a full target filled. And that's pretty much a perfect fake out trade. And I took this trade in real time with my team. I'll show that on the chart just now. Here's one more example of a false breakout trade. Here's the demand, here's the swing low. We have this break and push beneath the swing low. Then we have this very fast, strong reversal, closing the market back over some previous highs. Now this push here that we get confirms that we could potentially reverse and move to the upside instead of selling more. Now, this one was not a wick. So how can you be sure that a reversal is underway? Well, the first thing is, as we've said, we always want to wait for confirmation. So generally, every trade we take will be looking to see the market shift like this, especially when we're trading into these reversals, because obviously we don't know if it's a false break yet or not. So we always want to see that confirmational shift, meaning no trade should be executed until we get this break of structure. And if we get a break like this, where we have these strong momentum candles closing us above this high, after sweeping and reversing so quickly from this low, that's going to be good confirmation that we can take the market higher. Another thing you can do is just go up to a slightly higher time frame. If we take a look at just the 15-minute time frame here, we can clearly see that the 15-minute closed as a very large rejecting wick, which shows us that buyers came in under this low, sellers lost control of this market, and now the market could be ready to continue going up. So what we can do at this point is use our demand entry method as we did previously, and as we will for pretty much every single trade. We want to buy from demand with stops beneath the low and targets off towards some higher point, wherever that may be for you on that specific trade. Open supply zones, points of liquidity, whatever it is. Let's use this supply zone for our target for this trade because it's nice and simple. So now that we have that setup prepped, we have the fake out, then we have the reversal, we have the break of structure, we have a pullback to a demand zone, we buy with a stop beneath the low, targets into the highs. Let's see how that trade goes. As you can see, this one was a very fast trade, and in just a matter of a couple of hours, this would have ran all the way through towards your targets, giving you a 4.5% profit. So I hope you enjoyed that video. If you did, check out this one as well, or head to the link in the description. There's a free course in there that's going to take your trading to the next level. Thank you for watching. See you in the next video.